Okay, so I'm currently working on the best alternatives and the most competitive funds compared to SCHD. Because, of course, right now, SCHD is one of the most popular and best performing dividend funds on the market. But while doing this research, I'm sure you guys have been watching the news, and the financial system is having quite a hiccup right now. Silicon Valley Bank is in the middle of the conversation because they are the largest name so far tied up in this whole situation, but there's a fear, of course, of this spreading to other financial institutions, and somewhat surprisingly, Charles Schwab, the maker of SCHD, is one of these companies that's been heavily sold off recently. And because of this, I've seen a lot of chatter online like this, people asking what happens to the money you have invested in SCHD if the parent company, Schwab, has some kind of financial difficulty. So that's why today I'm going to put this research on pause and make a quick video on this current situation and what happens with a fund like SCHD if the parent company has some kind of difficulty. So the latest news with Silicon Valley Bank is that it no longer exists, it went bankrupt, but all of the deposits in the bank will be protected beyond the $250,000 insurance limit. President Biden spoke on the issue and he claimed that this is not a bailout and the actual investors, the shareholders of Silicon Valley Bank, are not being compensated or bailed out in any way for their losses.
Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
And allow me to give you guys a quick, basic, high-level overview of the dynamics involved in this meltdown, because you're going to need it to understand the contagion effect. All right, so Silicon Valley Bank is a specialty bank, even though they're pretty large, that focused on technology companies, right? I mean, it's in the name itself, Silicon Valley Bank. So when your clients are all from one specific sector or field, it makes you not very well diversified. But regardless, that worked fine for a pretty long time. So tech companies would come to this bank, open up accounts, and deposit their money with them. Then, just like any other bank, SVB takes a portion of those deposits and they loan it out, they make investments to generate some kind of return. A big portion of these deposits went towards very secure and safe US Treasury bills. Now, on the surface, that might seem like a good move. Treasuries are a risk-free return, so it's a responsible way to invest depositors' money. And yes, in a vacuum, that is true. The issue is they took out long-term Treasury bills back when rates were near all-time lows, about 1.5%. And since that point, we all know that the Fed has aggressively raised interest rates by about 5%. And the basic relationship here is that when interest rates go up, the value of existing bonds go down. I mean, when it comes to these long-duration Treasury bonds at 1.5%, why would you, right now as an investor, pick this over a new Treasury yielding 5%? The answer is you wouldn't, unless you can get them at a very cheap price. So with the availability of 5% yielding Treasury bonds, these long-term ones at 1.5% are just not as valuable as they once were. But technically, these are unrealized losses because they don't have to sell these bonds early for a discounted price. They can hold it until maturity and collect their principal back. But this is where we go back to the depositors and the very specific group of companies and clients that SVB focuses on. Technology companies. And rising interest rates also tend to negatively affect these companies. I mean, just look at the stock market in the past year, tech companies have been completely crushed. And in this environment where money is harder to come by, they might be coming back to their bank and doing more withdrawals than deposits. And that could force SVB to sell these long-term Treasury bonds and realize that loss. And then once word gets out that SVB doesn't have enough money to pay back all of their depositors, that's when you get the positive feedback loop, a bank run, and the whole thing just collapses. Now, at a macro level, of course, the big concern here is that this spreads to other banks, causing additional bank runs and bank failures. That's why so far this week, lots of other banks have been experiencing pretty negative price action, but you're going to notice that it's not evenly shared amongst the entire banking industry. It's banks that have similarities with Silicon Valley Bank, namely these two factors here. So factor one is long-term bonds, where they're currently underwater due to the rise in interest rates, and the other is a non-diversified deposit base. And something that really surprised me here is that so far this week, Schwab is one of these names being sold off. In fact, one day was so bad that the circuit breaker went off, pausing all trading on this company's stock. And you guessed it, the big culprit here is the massive amount of bond holdings with longer maturities that Schwab has. Although it's important to know that Schwab is a very different company than Silicon Valley Bank. First of all, they're many times larger. They're also much more diversified, and the company came out and said that they have plenty of access to liquidity and they have a low loan to deposit ratio. Now, I'm not going to tell you how to think. We have to see how the situation develops. Bank runs are a very real, devastating event, but there's also a very real possibility that this fear is overextending itself into other names that have no such problems. But regardless, something positive coming out of this event is people reevaluating the risk involved with putting their money in different locations. And one of the more intriguing questions I saw is, okay, hypothetically, if a company like Schwab does go bankrupt, what happens to those that invest in SCHD, an ETF that is from this company, but of course investing in other companies? And there's a really great comment here left explaining what might happen in this situation. So of course, the outcome varies based off of where exactly your money is. So the first situation is a bank account with FDIC insurance. And if you're in the situation, if the company itself goes bankrupt, then you are insured up to that $250,000 limit. The next category here is bank stock. So if you're invested in the bank that goes bankrupt, in this situation, you are a shareholder. And just like with any investment, if it goes to zero, you have absolutely zero protection. And then the third category is those managed funds. And he goes on to say that's not tied to the company. So if Schwab fails, a custodian will be assigned to oversee the liquidation of funds, and holders get current fair value equal to their stake back. So according to this, and again, this is not financial advice, always do your own research, but if a company like Schwab goes bankrupt and you happen to be invested in SCHD, the fund is going to be given to a custodian, liquidated, and you're going to get the current fair market value of those shares. Yeah, so that's a quick little summary of the craziness that's happening all of a sudden in the financial system this week. Again, I'm not an expert on this topic, but I'll leave some resources linked down below if you guys want to do some further research on this. And make sure to subscribe and stay tuned for my next video, which is going to be on all of the best alternatives to SCHD. It should be an exceptionally fun video, and I'll see you guys there.